Capital goods and engineering would be an interesting area to watch out in the current crisis. Well, most of the stocks in this sector have already corrected about 50% as investors fear about earnings downgrades in the coming quarters from here on. In the March quarter alone, while the impact was marginal, the larger picture will only get clear post the June and the September quarter earnings. Now, in our ideas for profit today, I will discuss if it is really better to avoid even the blue chip companies in the capital goods sector in these uncertain times. Let's first analyze the earnings of two key listed players in this space, that is ABB Limited and Siemens. ABB reported close to 18% decline in revenues, largely led by lower deliveries because of the lockdown. All four segments of the company reported a decline in the revenue. The jolt was felt in the robotics division, which saw a 46.5% year-on-year decline in its revenues. The robotic business reported a loss before interest and tax of close to 4.2 crore rupees, dragging the overall margins. Now, Q4 EBITDA margins fell by 700 basis points on a year-on-year basis to a mere 1% as against 8% in the corresponding quarter of last year. Net profits during the quarter declined by close to 45% on a year-on-year basis. It is expected that profit could shrink further in the coming quarters as well. On a positive side, ABB still is sitting on over 4,400 crore rupees worth of orders as against its annual revenue of 7,300 crore rupees. Now, in the March quarter, the company's orders were up only by 10% on a year-on-year basis to 1953 crore rupees. ABB looking ahead says all of our facilities which were shut down are now reopened and we are again restoring our supply chain. The workforce is also resuming and customers slowly are reopening their facilities as well. Siemens had a similar fate, reporting close to 21% year-on-year decline in revenues. Among segments, the highest decline was really witnessed in the mobility segment, which caters to the transport and the logistics sector, reporting a close to 30% year-on-year decline in its revenues. Now, most of the projects and equipment deliveries suffered because of the lockdown this time and possibly client-related issues of payment in the lockdown period as well. Now, this is also a reason that the consolidated EBITDA margins had dropped by 323 basis points on a year-on-year basis to just 8.4%. Now, segments such as smart infrastructure and mobility were the prime driver of the dismal operating performance this time. Thankfully, the operating performance of Siemens was still better than ABB Limited. Nevertheless, Siemens too saw a decline in net profits of almost 38% on a year-on-year basis. Now, even though the companies have gradually started functioning, the pain would get captured in the current quarter, that is Q1 of FY21, where the full effect of the lockdown and client-side issues such as execution delays, payments, project negotiation, deferment of capex would come to light as indicated by many of the private sector companies. Companies are also working on cost reduction as well as cash conservation to really deal with the situation. And both the stocks have really corrected close to 40% from their peak levels back in October last year. And despite this correction, we believe the valuations are still on the higher side and investors should therefore take a cautious approach.